Welcome to the premiere edition of CFO Chat. This is a spin-off from Business Redefined, where we bring you exclusive conversations with the chief financial officers of companies as and when they release results, I should say. And we are privileged to have Abraham Ongenge from Stanbic Bank, which has just released their numbers for full year 2020. Congratulations on the numbers.
Thank you.
I should mention I am pretty surprised by the dividend payout, 3.80 shillings per share, about 1.5 billion shillings total payout, considering the environment we are in and the necessity of capital preservation. And when I look at your capital buffers, granted they're above the thresholds, but still you can see a bit of a slide in the liquidity ratio. Are you bothered by this?
No, not actually. We have looked at the capital buffers way above the regulatory requirements. We also do consider our forecasting around stress events, and we are comfortable that we will be able to pass on some of the earnings of this year to our shareholders at 3.8 per share.
I see. Breaking down your income, if you look at the non-interest income category under the segment of other income, there was a massive decline from 1.46 billion shillings in 2019 to just 611 million shillings in 2020. What explains this plunge?
Yeah, last year we had a bit of a one-off. We did dispose some bonds profitably, and this was really to reposition our books based on the various changes in tax laws that happened in the year 2019, which were eventually reversed. So that was really just one-off in the year 2019.
I see. And speaking about disposing of some bonds to reposition your book, if I look at your income, your interest income from government securities at 4.53 billion shillings was up 10.76%. Interest income from loans and advances was down 8.7% to stand at 14.37 billion shillings. Are you now going back to the rate cap stance where, of course, banks are taking the safe haven of government securities to cushion themselves?
Not really. If you do recall, starting from the lifting of the interest rate cap, we have seen the central bank rate reduced by about 200 basis points since then. And that does affect the earnings, the yields you get on loans and advances. So it's largely a reduction in the yields of loans and advances and not necessarily a push towards government securities.
I see. Another thing which really stood out to me in your numbers, if you look at the deposits due to local banking institutions, it surged from 103 million shillings to 12.7 billion shillings. Mm-hmm. What explains this?
Yeah, you're talking about loans from banks?
Yes, correct.
Yeah, so we do place a little bit of our money in our loans to banks from a short-term perspective. So once we start transferring some of this into government bonds and also some of it into loans and advances, you would expect some one-off reductions. So it's really a temporary placement while we look to grow our balance sheet in loans and advances and also try to grow our balance sheet in government securities.
Okay. Let's switch focus to the SBG business. I mean, granted, the capital markets here, the investable opportunities are significantly eroded. But when I look at the numbers of SBG securities, net earnings are down a whopping 71.3% to just 34.9 million shillings. That's not a very interesting position to be at.
Yeah, it is reflective of the performance of 2020 on the Nairobi Securities Exchange, not necessarily similar to what we had in the year 2019, but also we do need to reflect that last year we were key transactional advisors for one large transaction in the market, which is the Kenol Kobil Rubies transaction, and that did boost our income in the year 2019.
Also, it's more reflecting a one-off development as opposed to attrition of your income over time.
Not. In fact, we are quite confident that our market share remains resilient in the securities exchange.
But staying on that note then, how robust is your transaction advisory pipeline looking forward? Because clearly the kind of environment we are in perhaps has suppressed the deal activity we are seeing in this market.
Yeah, I think our discussions with our clients and various customers does show that we will see some resumption in that. But having said that, we do see our responsibility in growing the market by participating in looking at new ways to boost market activity. One of the things that we are watching quite closely is the derivatives market, which is kind of on its nascent stage in the securities exchange, and we are key participants in that.
All right. Closing our conversation, looking at your asset quality, gross NPLs up about 29.4% to 25 billion shillings. The industry now, the NPL ratio is up to 14%. How comfortable would you say you are with this asset quality?
Yeah, I do not think the effects of COVID have kind of subsided yet. We still do see some residual effects of COVID, but we are confident that we're starting to see offshoots of rebound in some of the key markets which we support. So we do think from an NPL perspective, we are kind of going into a plateau. And given the developments around the vaccine and some resumption into normalcy, we will see that number starting to come down. Specifically for us, we are optimistic that the number will come down.
All right, and my final question. When you look at the fact that when the restructuring of loans under the CBK guidelines began in March, they actually are lapsing as we speak. So looking ahead, how would you say you are positioned from a portfolio at risk perspective, and what guidance are you giving your clients as far as restructuring going forward is concerned? Because as you said, there are a number of residual effects of COVID-19, which will still be felt perhaps 2 years into this.
Yeah. The interesting thing around what we've seen over the year when we had restructured loans is that most of our customers have resumed paying their loans. Out of 40 billion that we restructured during the year, we've seen 90% of that customers coming back to us and saying that they are able to start repaying their loans. But we understand that the effects of COVID is going to continue. And therefore, we are available to our customers on a case-by-case basis to discuss any extension of restructures. Now, the one thing that we do need to innovate as banks, which we have done, is to kind of tie the repayments into the affordability of our customers. And some of the things that we've innovated even within our systems is to accommodate customers who can pay a little bit less, but have a little bit of their allocations from their earnings to service their loans.
Sorry, Abraham, allow me to ask this before we close. Stanbic has restructured 40 billion shillings worth of loans as we speak. Only 7% is attributable to SMEs, and this is a bit contrasting to the overall market whereby the predominant restructuring has been with SMEs. Does this speak to your client profile, or what exactly explains this divergence from the market trend?
It does tie to the structure of our book. About 48% of our book is corporate-based, so not necessarily SME-based. And the remainder, only half of it, you'd say, is within the commercial banking and the SME sector. Within the SME sector, we are also banking the value chain of our corporates, so there's some level of income protection for our SMEs. So you'd see a lot of our restructures tending towards the personal side, and the SME ones being a little bit more protected because they do receive revenues through the corporate value chain.
All right, and that takes us to the close of our conversation with Mr. Abraham Ongenge, who is the CFO at Stanbic Bank, just released the results. Stay tuned for the next edition of CFO Chat with whichever company will be releasing the results next.